Hello, and welcome to Explain the Charts, your go-to channel for in-depth market analysis. Today is October 9th, 2025, and we're breaking down the S&P 500 ETF, ticker symbol SPY. The market has been on an absolute tear, hitting new records, and we're going to unpack the news driving this move first. First, let's talk about the macro environment, because the market is being pulled by several powerful forces right now. The biggest headline is the market itself, with the S&P 500 notching its first record close above the key 6,700 level. This rally is being fueled by a few key narratives, with the primary driver being the relentless optimism surrounding the AI boom. Major deals involving tech giants like Nvidia and AMD are sending waves of bullish sentiment through the sector, which provides a massive tailwind for the entire index. Adding fuel to the fire are the increasing bets on Federal Reserve interest rate cuts. Recent private payroll data came in unexpectedly weak, which has ramped up expectations for more accommodative monetary policy. The market is now pricing in a near 100% chance of a rate cut at the next meeting, and the Fed's own minutes seem to confirm that more cuts are on the way. However, there's a significant elephant in the room: the ongoing government shutdown. So far, the market has completely shrugged this off, but the shutdown is causing a critical lack of official economic data, like the jobs and inflation reports. This forces everyone, including the Fed, to fly blind, increasing uncertainty and the risk of a policy mistake. While the market is resilient for now, a prolonged shutdown could certainly start to weigh on investor sentiment. On the corporate front, recent earnings have been supportive, with companies like PepsiCo and Delta beating expectations, adding to the positive mood. It's a complex picture, a euphoric, AI-driven rally running headfirst into significant political and economic uncertainty. Now, let's see how these narratives are reflected in the price action on this daily chart for SPY. The long-term trend is undeniably bullish. We've been in a powerful uptrend for most of the year, consistently setting higher highs and higher lows. The price is currently trading at all-time highs, right around 673, which is our most immediate and obvious level of resistance. A strong break and hold above this level would signal a continuation of this powerful move. Looking down for support, our first key area is the recent low from early October around the 667 to 669 zone. Below that, the lows from late September in the 654 to 658 area provide a more significant support level, as this was the launchpad for the most recent leg up to new records. The real story of resilience on this chart, however, happened back in the spring. Let's zoom in on that period from early April. Here we can see an incredibly volatile drop from around 565 down to a panic low of 481 on April 7th. This was immediately followed by a jaw-dropping 11% single-day rally on April 9th. This explosive reversal established a massive long-term support zone between 480 and 500. The fact that the market recovered so violently from that sell-off shows the incredible amount of buying pressure that has been underlying this market all year. Now let's switch to the 1-hour chart to get a clearer picture of the recent price action. Over the last couple of days, we can see a very constructive and steady uptrend. The market gapped up at the open on October 8th and has been grinding higher ever since, creating a series of higher lows. This shows consistent demand throughout the trading sessions. The immediate short-term support to watch here is yesterday's low around 669.42. A hold above this level keeps the immediate bullish momentum intact. Resistance is, of course, the recent high just above 673, an area we've tested a couple of times, showing some selling pressure is present at these record levels. For an even more granular view, let's look at the 15-minute chart from yesterday's session. After hitting the high of the day around 673.20, the price spent the rest of the afternoon consolidating in a tight range. This sideways action represents a balance between buyers and sellers. Day traders would be watching this consolidation pattern closely. A break above the range high could signal another push-up, while a fall below the range low around 672.20 could indicate a short-term pullback is starting. Okay. Let's go back to the daily chart to recap and look ahead. The market is in a clear uptrend, but at very extended levels. Key price levels to watch are critical right now. To the upside, the all-time high around 673 is the immediate resistance. A decisive break above 675 would open the door for a move towards the psychological 680 and even 700 levels. To the downside, short-term support lies at 669 to 670. A break of that could see us test the more significant support zone of 654 to 658. So, what's the outlook? Let's consider two scenarios. The bullish scenario, which I see as having a 70% probability, is that the combination of AI hype, positive earnings, and the promise of Fed rate cuts continues to push the market higher. This would be reinforced by dovish comments from Fed Chair Powell or another blowout earnings report from a major tech company. In this case, we would expect to see the 675 resistance level broken within the next week. The bearish scenario, with a 30% probability, is that the market's frothy condition finally meets a catalyst for a pullback. This could be hawkish talk from the Fed, a negative development in the government shutdown, or a major geopolitical event. If this happens, a break below 667 could lead to a swift correction back towards the 655 area. The main things to watch in the coming days are any speeches from Fed officials, especially Chair Powell, and the start of the Q3 earnings season in earnest. These events will likely set the tone for the next major move. Finally, a quick disclaimer. This analysis is for educational purposes only and should not be considered financial advice. Trading and investing involve risk, and you should always conduct your own thorough research and consult a financial professional before making any decisions.